Probably seen this one on some listings lately. Assumable loan, seller's rate is just 3.25%. That means instant savings, which sounds amazing, right? You take over their loan and live happily ever after. Well, the truth, not exactly. Let's talk about what assumable actually means and what you need to know before you start packing your boxes. An assumable loan lets a buyer take over the seller's existing mortgage. Same rate, same balance, same term, instead of applying for a brand new mortgage. Sounds simple, but there are a few catches most people, including the listing agents, don't realize. First, let's cover which loans are actually assumable. Number one, FHA loans are assumable. Number two, VA loans are assumable, but that seller's eligibility can stay tied up if it's not released correctly. We'll talk about that more later. USDA loans are also assumable as well, although I don't personally come across them very often. People will ask, what about conventional loans? Typically not. They have what's called a due on sale clause, which means when ownership changes, the lender calls the loan due. So unless it's FHA, VA, or USDA, that assumable claim in the listing probably isn't real. Now here's the big gotcha. It's called the equity gap. You are not assuming the home's price. You are assuming the loan balance. So to use some numbers, if the seller owes $300,000 on the loan that you are assuming, but the house is selling for $500,000, you have to cover that $200,000 difference somehow, either cash out of pocket or a second mortgage. And those second mortgages are usually at a pretty high rate these days, and you're still going to end up bringing in some cash. That's where most of these deals tend to fall apart. The process itself can be a little clunky. I've been involved in facilitating a couple of them, even though I'm not originating the loan. You still have to apply with the current servicer just like it's a mortgage. So you have to provide income, they pull credit, and you have to wait for an approval. Now, in theory, this is supposed to close in about 30 days. Reality, I've seen many take 90 to 120 days because the servicers are not bank lenders. They are not staffed to process applications. So if you're writing an offer on an assumable home, plan for a long escrow and make sure the seller understands that's going to possibly happen as well. For VA loans, now this part is very critical. If a non-veteran buyer assumes a VA loan and the seller does not get a release of liability and substitution of entitlement, I know it's a lot of acronyms here, the seller's VA benefits remain tied up in that house. They cannot use their VA benefit again until that is corrected. So agents, if you're listing a home with a VA loan and you plan to market that it's assumable, don't just say assumable, verify the process and help your client protect their entitlement. Other fine print on FHA loans, they keep their mortgage insurance. A lot of people don't realize this about FHA loans. The mortgage insurance no longer falls off like it used to a long time ago. That means you have it for the life of the loan, even if you assume it. So you may be assuming a 3% interest rate. There may be more than 20% equity in that house, but you are still going to be paying the monthly mortgage insurance premium. USDA loans, they require a separate USDA approval, which can add extra time as well. Similar process to VA and FHA otherwise. No matter what, both sides are going to pay an assumption fee and closing costs. These typically are not free. So people will ask, when does this make sense? Kind of two scenarios. One, if the equity gap is really small, or two, if you were planning on bringing in a ton of cash into this deal anyway to cover the equity gap, then it's a fantastic deal. An assumable loan, I mean, at the interest rates that you can get, you just can't beat that on the market. But if the seller owes $250,000 and you're buying for $550,000, that 3% rate isn't saving you anything if you have to finance that additional cost with a second mortgage. It's probably going to come out higher than just getting a regular loan. It's not about, can I assume the loan? You need to think about, does the math actually make any sense? So here's the bottom line. Assumable loans are real and they can be very powerful, but they are not a magic bullet. If you're an agent, verify the loan type and the balance before marketing it. If you're a buyer, know what you're really assuming and how you'll handle the cash gap. That low rate might come with a few strings attached. If you're looking at a home with an assumable mortgage, reach out before you make an offer. I'll walk you through the real numbers and tell you if it's actually a deal or just a good marketing copy. I do home loans in Arizona, Oregon, and Washington, and I am more than happy to help out.